Welcome to the Women in Wealth podcast, brought to you by Regina McCann Hess, a certified financial planner with over 2 decades of experience. This show is for professional women who want guidance in working towards their retirement vision in learning, building, planning, striving for your dreams, and putting the work in now so that you can pursue your financial independence. Hello, I'm Regina McCann Hess, president of Forge Wealth Management, and welcome to our Women in Wealth series. Today, we're going to talk about investment experience as far as it goes with volatility. And volatility is usually a scary conversation. It's a scary thought, but guess what? It happens all the time. If you're going to be in the market, you're going to have volatility. You're going to experience volatility. So we're going to talk about the 10 things that you should know about stock market volatility. And obviously, volatility is part of the investment experience, but the longer an investment is held, the greater the potential for the overall positive return. That doesn't mean you're not going to have angina along the way or heartburn, but long term, those ups and downs usually are not as bad as the short term picture of them. So the first item on our list is that you have to put it into perspective. Sometimes the headlines bear news of the market going up and the market going down. They might say the Dow Jones Industrial Average was dropping today, which will incite even more market fear and potentially drive the market even lower. But just remember, it's all relative. So a 1% swing at the end of 2024 levels was equal to about 425 points. Whereas when the Dow was at 10,000 points, a 1% swing was only 100 points. So volatility is a matter of perspective. And you're going to hear those headlines on the news pretty much every other day. Market was up today, the market was down, and then they'll throw some scary headline in there to make you even more fearful. So you do just have to get that little stronger stomach to be able to be in the market and withstand the knee-jerk reaction of wanting to run for the hills. So the item number 2 is that there's an index for that fear. The fear index is referred to the VIX, and that's the CBOE VIX, VIX index. And that measures the market's expectations for volatility over the next 30 days. So the VIX tends to have an inverse correlation to the S&P 500 index. So when the market is down, fear is up and vice versa. So a score below 20 generally indicates investor contentment. A score above 30 suggests anxiety. So that is whenever the VIX is trading higher, then people are basically a little bit more nervous. Okay. Item number 3 is the only thing to fear is extreme fear itself. I seem to remember a president saying something about fear, but a VIX score of 40 or higher indicates extreme fear among investors. Now, this doesn't happen very often. In fact, since 2010, the VIX has only spiked about 51 trading days above 40. So that's also something to keep in mind. Item number 4 is don't let bad days blind you to good days. So since the VIX's inception, in 1990, 61% of the days of extreme fear occurred in 2008 and 2009. Sounds about right. I do remember 2000, 2008, and 2009. It was really scary. Everybody was fearful, and the VIX was pretty high during that time. That was the global financial crisis. So if your VIX isn't high during a crisis, then there's something wrong with the index, right? So most years, like 26 years since 1990, we don't really see a single day when the VIX has hit over 40. Now, historically, extreme fear has been the exception, not the rule. So what's that mean? It doesn't happen that often. So those are extreme cases like the 2008 financial crisis. So that makes more sense to see numbers up really that high at that point. Okay, item number 5. Volatility in 2024 was much lower than usual. Now, we were expecting volatility and it just didn't materialize. So, with a backdrop of moderating inflation and several pauses in interest rate hikes by the Federal Reserve, volatility in the S&P 500 index was in 2024 was less than the 10-year historical average from 2014 to 2023. Of that, only 19% of the trading days in 2024 had swings of plus or minus 1%. To us, reading the statements each month, I was like, that's not such a bad year. We enjoy that quiet type of activity. So, number 6 is patience is a virtue, and that's a question mark. So while investing in the stock market does have its ups and downs, the longer an investor stays invested, the less significant those bumps in the road appear. So as represented by the S&P 500 index, stocks have tended to be up more often for investors who held on for longer. So what's that mean? Basically, your time in the market helps even out those speed bumps that we come across. And that doesn't mean you're not going to have speed bumps. You will have speed bumps, and you have to know that going into the stock market. Even if you're in a mutual fund or an ETF, you're still in the stock market if it has equity in it, and you are going to have good days and you're going to have bad days. And sometimes those days feel like a speed bump, and other days it feels like you're on a roller coaster. So you do have to have some patience. And yes, I do believe patience is a virtue for those types of situations. Item number 7. No one said it would be easy. So from 1985 to 2024, the S&P 500 returned an average of 11.78% per year. And investors may have expected similar 11% returns in any individual year. However, there were only 3 years in which the index returned between 9 and 12% during that time period. So volatility is much easier to tolerate when you do expect it. If they tell you, hey, this is going to hurt and it hurts, you're like, okay, yeah, it did, but not as much as I thought it was. It's the hindsight that you're like, ooh, a lot easier than I thought it was going to be. Let's go on to number 8. Want to minimize volatility. So if the market volatility makes you uncomfortable, you can work with a financial planner, financial professional of some sort to include investments in your portfolio that specifically seek to help minimize volatility. Now, you can do that without abandoning your growth-oriented investments as well. But obviously, it takes some planning. No plan is perfect, right? So you are going to experience loss at some point. When the market's up, you're enjoying that, right? When the market's down, you're like, oh gosh, that really stinks. My statement doesn't look so pretty. But you can build things into your portfolio to hopefully help make it a little softer of a landing. Okay, item number 9. Embrace volatility. So if you're able to put aside the day-to-day discomfort of market volatility, it could provide the opportunity for higher returns. So while trying to time the markets is very much ill-advised and has historically not worked very well for people, investing during down markets is exactly in line with the old financial adage of buy low, sell high. But it's hard to do, right? Now, human emotion gets in the way because we're like, oh my God, the building's on fire. Let's get out of here. Meanwhile, the firemen and women run into the building and put the fire out. So it's really hard. But when the markets experience real downturns and significant downturns, those are good buying opportunities. You do have to have a strong stomach for it, though. It is not for the faint of heart. However, long term, when people do stuff like that, invest on those dips and hold that money or investment long term, it tends to do very well for them in their overall planning and investment strategy. All right. Item number 10, remember the glass has been more than half full historically. So if you're swept up in volatility, remember that the markets have been positive more often than not. In fact, stocks have turned in a positive return 67 out of the last 68 years, which means they've been on the rise 76% of the time. Saying I'm thinking I'm going to take that one. Again, it's about time in the market, not timing the market. So you do have to be careful with that. You don't want to try to, oh, the market's going down right now, so I'm going to sell and sit on the sidelines and wait for it to come back and then go in. back in. And that's where a lot of people, that's an emotional reaction. And that's where a lot of people tend to lose ground when they do things like that. Making sure that you're prepared for market volatility and that you can ride out that storm is really an important way to handle that. Making sure, that if you need any cash from that portfolio, it should not be in the equity side of the equation. It should be in shorter term, safe money markets, bank accounts, things like that, CDs even. But if it's longer term money, that's where you want to consider using the stock market. Okay. Now, obviously, past performance does not guarantee future results. We have to say that, right? So even though we have all this history behind us and we see how it works, hey, guess what? Anything can happen. So anything could surprise us. So we do want to be careful of that. But again, we do like long-term investors, that mentality, because we tend to see a little less volatility over the long term. And I forget who wrote this, Stocks for the Long Run. I should know that, but that was a really good book. I mean, it's dated. I really am dating myself by saying that book title. It's over 30 years old, I think. So we'll stop quoting book titles, but it basically talks about time in the market and holding things for a reason and not just being in and out of the market. So with that, I want to say our action item is to know why you are investing, for the time frame that you're investing, and what your risk parameters are and what can you stomach as far as risk when you're investing in the stock market. So that is our helpful hint for today. Action item, there you go. Thank you so much for joining me today. I am, again, Regina McCann Hess, president of Forge Wealth Management. You can follow me on Facebook, Twitter, and YouTube at Forge Wealth. On LinkedIn, Regina McCann Hess. My website is forgewealth.com. I do want to read a compliance little blurb here. So with that, thank you for joining me on this episode of Women in Wealth. You can watch my founders video that I created for you to learn more about me and how I can guide you towards your financial independence at forgewealth.com. The information in this podcast is, of course, educational and general in nature and does not take into consideration your financial and your personal circumstances. Therefore, it's not intended to be a substitute for specific individualized financial, legal, or tax advice. Now, to determine which strategies or investments may be suitable for you, you want to consult the appropriate qualified professional prior to making a financial decision. The material that was used to prepare for today is from Hartford Funds. Thank you, Hartford Funds, for giving us that material. And securities are offered through LPL Financial, member FINRA, SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Hartford Funds, Private Advisor Group, and Forge Wealth Management are separate entities from LPL Financial. Our show guests and their companies are not affiliated with nor endorsed by LPL Financial, Private Advisor Group, or Forge Wealth Management. Thank you so much. Have a great day. Thank you for joining me for this episode of the Women in Wealth podcast. You can watch the founders video I created for you to learn more about me and how I can guide you towards your financial independence at www.forgewealth.com. The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision. Securities are offered through LPL Financial, member FINRA, and SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Forge Wealth Management are separate entities from the LPL Financial. Our show guests and their companies are not affiliated with nor endorsed by LPL Financial, Private Advisor Group, or Forge Wealth Management.